Hello, everyone. Welcome to ESG 101, an introduction on environmental, social, and governance for financial analysts. Whether you're in investment banking, commercial banking, private industry, or investment management, you will no doubt be faced with growing interest in ESG and how it informs your or your company's decision-making. The intention of this course is to prepare you with the foundational knowledge needed to respond effectively to these inquiries and leverage ESG information to conduct more effective due diligence and to make better investment decisions. In this course, we'll start getting an understanding of what ESG is, how ESG information is used to assess risk, reward, and management effectiveness. We'll then discuss how stakeholder expectations influence corporate action on ESG, followed by unpacking some key considerations for both corporations and investors. And finally, we will end the course by working through an exercise to assess portfolio risk and provide recommendations to management. Summit Strategy Group works with Fortune 500 companies to develop and deploy enterprise-wide ESG programs and advises C-suite leaders, including finance and investor relations executives, on leveraging ESG as a competitive advantage in the marketplace. Our experience in advancing ESG progress at every level of the organization, from the C-suite to the facility associate level, has given us unique insight into the relevance and importance of ESG across industries, functional areas, and stakeholder groups. Chapter 1, Lesson 1. What is ESG? ESG refers to environmental, social, and governance, and the way in which these issues converge to impact a company and a company's stakeholders. Environmental criteria refers to a company's environmental stewardship, including how they manage the impacts of their operations, products, and general business activity on the environment. Social criteria refers to how a company creates value for stakeholders and includes related concepts such as corporate purpose and societal impact. Governance ultimately refers to how a company is led and managed. ESG is used as a framework to assess how a company manages risks and opportunities that shifting market and non-market conditions create. These shifts include changes to natural systems, social systems, economic systems, ultimately impacting the entire landscape a company operates in. Although ESG can touch upon socially conscious concepts, ESG is ultimately not about values. ESG is about the ability to create and sustain long-term value in a rapidly changing marketplace, economy, and world, and managing the risks and opportunities associated with these changes. It's important to note, there is no universal categorization for ESG issues. Some issues can be categorized or defined in different ways, depending on the industry, the unique characteristics of the company, or their business model, or the standard used to disclose information. For example, some companies and investors define diversity, equity, and inclusion, DEI, as a social issue to address through their hiring practices, their community engagement efforts, or their procurement strategies. But some also define DEI as a governance issue, viewing a more diverse board and workforce as essential to making more informed decisions, spurring innovation, and supporting the acquisition of new customers and markets. This lack of uniformity is even more reason that you as an analyst must be able to break down the issues and assess how they may impact performance and profitability. ESG is often used interchangeably with corporate social responsibility or corporate sustainability. Yet ESG is a much more important thing than that. Before we dive into what ESG is, though, let's look at where the concept of ESG came from. The early underpinnings of ESG came from the growing recognition that environmental and employee issues were material to a business. EHS, or environmental health and safety, was based on the development of and the subsequent compliance with environmental and employee regulations, which evolved into the idea of corporate sustainability, or a company's approach to minimizing their adverse impacts on the environment beyond what was legally required. Corporate sustainability then began to integrate ideas around how a company responds to social issues, known as corporate social responsibility. Corporate philanthropy and employee volunteerism were key tenets of CSR. Now, in the 2020s, ESG has evolved into a more holistic concept associated with competitive advantage, greater management of risks and rewards. Let's now dive deeper into the ESG issues and their relevance on business today. What are the forces behind ESG becoming a mainstream business concept? The growth of ESG is due to three factors. These are materiality, the growing recognition by investors and academic researchers that ESG influences investor risk and returns. Another reason is client demand for greater transparency around how their money's invested. Lastly, regulation has played a key role, especially after the 2008 financial crisis. National and international regulators viewed the private sector as a key driver for both contributing to and addressing global public threats, such as climate change and human rights violations. Some high-profile examples of financially material ESG incidents, which influence greater client demand for transparency and regulator demand for ESG to be recognized as fiduciary duty, include BP's U.S. Deepwater Horizon oil spill in 2010, where BP received $53.8 billion in fines, cleanup costs, and local reparations. In 2015, Volkswagen was charged 27.4 billion euros in penalties and fines for rigging 11 million diesel vehicles to pass emissions tests. And lastly, in 2018, Cambridge Analytica harvested the personal data of 87 million Facebook users, resulting in Facebook losing billions in market value. There are several types of sustainable or socially responsible investing, and these terms can often be confusing. Let's walk through each of the main terms and some real examples of these types of capital allocation decisions. Socially responsible investing, SRI, is when potential investments are screened according to specific ethical guidelines. SRI screens can include issues like gambling, tobacco, weapons, or fossil fuel companies. Some examples of SRI funds include Vanguard FTSE Social Index and SDRP S&P 500 Fossil Fuel Reserve. Impact investing. In impact investing, positive social and environmental outcomes are the key objectives, not necessarily shareholder returns. For example, the TIAA-CREF Social Choice Bond holds a bond that helped a group provide vaccinations to 44 million children. Green bonds. Although closely associated with ESG and ESG-centric companies tend to issue green bonds to support their efforts, a green bond is a fixed income instrument designed to specifically support projects related to climate change and environmental stewardship. A company with a mature ESG presence would be more likely to issue a green bond than a company with an immature or non-existent ESG presence. ESG. Although there is some crossover in these concepts, ESG is ultimately a measure of greater risk and reward management. An example of an ESG fund includes iShares, MSCI KLD 400 Social ETF, a mutual fund that focuses on companies with mature ESG strategies.